Welcome back to Talk Tickers. Today we are stripping down the machinery of the Q4 2025 earnings call for Amatech Inc., ticker symbol AME.
Right.
Now, I have to admit, if you're just casually scrolling through financial news, Amatech is, it's one of those names your eyes might just glaze over.
Totally. It sounds very generic.
It sounds like a company making, I don't know, motors and gauges. But if you've been following our research notes, you know that calling Amatech a manufacturer is, well, it's technically true, but it misses the entire point.
It's like calling Berkshire Hathaway an insurance company. Yes, they sell insurance, but that's just the engine for something much, much larger.
Yeah.
Amatech is what the street calls an industrial compounder.
Right. And compounder is one of those buzzwords that gets thrown around a lot. But in this case, it means something very specific. They aren't just trying to sell more motors. They are an execution machine. They're designed to acquire these niche businesses, strip out all the inefficiencies, and just supercharge their cash flow.
It's almost like a private equity firm that's operating inside a public industrial shell. That's the perfect analogy.
And that machine was put to a serious stress test this quarter.
It really was. We saw some fascinating volatility right when the numbers dropped. The stock fell about, 4% in pre-market trading?
Which usually signals a disaster.
A disaster or a huge miss. But then it spent the rest of the day just clawing its way back to close green, up about 0.5% at $228.92.
So that's the mystery we need to solve today. Why did the market initially choke on this news? And then a few hours later, why did it change its mind? It feels like a tug of war.
It was exactly that. It was a battle between two narratives. On one side, you had the clean beat. I mean, the operational numbers for Q4 were record-breaking.
Yeah, on the other.
On the other side, you had a forward outlook for 2026 that the algorithms read as weak because of one specific scary word: tariffs.
And we're definitely going to unpack the tariff situation because management's response to that was pretty surprising to me. But let's start with that clean beat. The headline numbers were massive.
They were.
Revenue hit a record $2.01 billion, up nearly 14% year over year. That beat the consensus of $1.95 billion.
And on the bottom line,
adjusted EPS came in at $2.01, beating the street's $1.94.
Those are the headline grabbers. But if you look under the hood, the quality of those earnings is what really, really stands out. I mean, anyone can manufacture a beat by cutting R&D or playing tax games.
Right.
But Amatech did this through core operational excellence. Look at the margins. Core operating margins expanded to 27.6%. That is up 140 basis points year over year.
Okay, let's pause there for a second. For the listener who doesn't stare at industrial balance sheets all day, why is 140 basis points significant? Sounds like a rounding error.
In the software world, sure, it might be. But in the industrial world, where you're dealing with raw materials, factories, supply chains, moving margins when you're already in the high 20s is incredibly difficult. It's like trying to squeeze water from a stone.
So their competitors are just trying to stay flat.
Most of their competitors are fighting tooth and nail just to keep margins flat against inflation. The fact that Amatech expanded them so much proves their whole niche strategy works. Yeah. They aren't selling commodities. They're selling mission-critical parts that customers have to buy, regardless of price.
And that margin expansion feeds directly into cash flow, which I know is your favorite metric for this company.
Oh, it's the star of the show. Absolutely. They posted record free cash flow of $527 million for the quarter. But the number you really need to circle is the conversion rate.
Conversion rate?
Their free cash flow conversion was 132% of net income.
Okay, let's explain that math. 132%. So for every dollar of profit they report on paper, they're actually generating $1.32 of cold, hard cash in the bank. How is that possible?
It usually comes down to extremely tight working capital management collecting from customers faster than you pay your suppliers, and things like depreciation. But for an investor, this is the golden metric.
Why is that?
Because Amatech's entire strategy is M&A, mergers and acquisitions. They need cash to go shopping. If this conversion number drops, the whole flywheel slows down. But at 132%, the machine is just swimming in liquidity.
Which brings us back to the wobble. If the machine is running so efficiently, generating all this cash, why did the stock drop in the pre-market? Why did the algorithms panic?
It all comes down to the guidance for fiscal year 2026. Management guided for earnings per share between $7.87 and $8.07. Yeah. The midpoint of that range is $7.97. The problem? The street consensus, what all the analysts were expecting, was sitting at 801.
So they missed the whisper number by 4 cents on the yearly guide. That seems negligible.
In a rational world, yes. But in this market, any guide below consensus gets punished instantly. Management explicitly flagged tariff uncertainty as a reason for being conservative.
So the algorithm saw tariff, saw the guidance miss, and just hit sell.
Hit the sell button, exactly. But then the humans read the transcript. And what they found seemed to completely contradict that fear. Let's talk about strategy, specifically this M&A flywheel.
Right. CFO Dilip Puri dropped a huge number. They have $5 billion in capital capacity to deploy.
That is a massive war chest. And remember, they can deploy that while keeping their investment grade rating. This isn't reckless, it's calculated. And we got a real-time update on how they're using it. We need to talk about FARO Technologies.
Right. They bought FARO for about $1 billion recently. This is a 3D metrology company, lasers, measurement arms, really high-tech stuff. But I noticed something in the notes that made me skeptical. When they bought it, FARO's margins were unimpressive.
Unimpressive is polite. For Amatech, mid-teens EBITDA margins are pedestrian. But this is the fixer strategy in action. This is why you buy Amatech. You aren't buying them because they find perfect companies. You buy them because they find good technologies trapped inside messy companies.
So they see potential.
CEO Dave Zapico was very clear. They plan to double those margins to 30% within a few years.
Doubling margins, that is a bold claim. I mean, usually when a company says synergies, they just mean we hope. How do they actually plan to do that? Is it just firing people?
That's part of it, sure, but it's more structural. They've already split FARO into two distinct units, metrology and digital reality. They do this for accountability. Suddenly you can see exactly where the money is leaking.
I see.
They took a $17.6 million charge to restructure, which is code for cutting costs, eliminating redundancies, and removing the public company costs. Being public is expensive. Amatech strips all that away, integrates the back office, and applies their pricing discipline.
So they strip the house down to the studs and rebuild the interior.
Exactly. And they are already seeing results. Zapico said the integration is on track. But they aren't just fixing old stuff. They're buying new toys. They announced a new deal right on the call, LKC Technologies. This one sounds fascinating. It's a smaller deal, but it's in eye diagnostics.
I saw that. It's a device for detecting diabetic retinopathy. But why this? It feels a little outside their wheelhouse of industrial motors.
It's actually a textbook niche acquisition for their electronic instruments group. But here's the kicker, and this is why Amatech loves it. 40% of the revenue is recurring.
Recurring how? It's a hardware device. You sell it once, right?
Sensor strips. To do the test, the doctor has to place these little sensor strips on the patient's eye. It's consumable. So Amatech sells the device once, but they sell the strips forever. It's the classic razor and blade model.
Ah, okay. High margin medical tech and that recurring tailwind.
Which protects them from economic downturns. And you mentioned they seem to be building a medical empire look at Paragon Medical, another recent buy.
Right. What's the update there?
Paragon is the proof of concept. Remember, when they bought Paragon, the market worried it would dilute margins. Now, Paragon is ahead of schedule. Their margins are already in line with the broader Amatech fleet. This validates the whole thesis.
If they could fix Paragon in a year, it gives investors confidence they can do the same thing with FARO.
Exactly.
Okay, so we have the buy and fix strategy working. Now let's loop back to the elephant in the room. Tariffs. Management cited tariff uncertainty for their conservative guidance, which spooked the market. But then later in the call, CEO Dave Zapico dropped a statistic that seemed to completely contradict that fear.
This is my favorite part of the call. This is a massive flex. He stated that in Q4, their pricing actions offset inflation, plus the tariffs, plus an additional 50 basis points of margin.
Wait, I want to make sure I understand this. They didn't just break even on the extra costs. They actually made more profit from the chaos.
That is exactly right. In a world where every industrial CEO is crying about how tariffs are going to hurt demand or crush margins, Amatech is saying, we have such specialized mission-critical products that we can just raise prices, cover the tariff, cover the inflation, and still take a little extra off the top.
That is a serious power move, but how is that sustainable? Eventually, customers have to push back, right? You can't just raise prices forever.
You can if you are innovating. And this is where the Vitality Index comes in. This is a metric Amatech uses to track innovation. They reported that 30% of their sales in the quarter came from new products introduced in the last 3 years.
30%. That seems incredibly high for an industrial company. Usually you see that kind of turnover in like software or consumer tech.
It is high, and it explains the pricing power. If you're selling the same motor you sold 10 years ago, your customer knows what it costs to make and will grind you on price. But if you're selling a new best-in-class elemental analyzer or a new cooling system for a defense drone, the customer has no benchmark. They just need the best specs.
New products have inelastic demand.
Exactly. That is how you beat inflation and tariffs.
And speaking of those products, let's touch on defense. We hear a lot about the defense supercycle, and Amatech seems to be right in the middle of it, especially in Europe.
They are. They highlighted specific wins. Cooling solutions for European air defense systems, computing for aircraft, power generation for UAVs. With European defense spending ramping up, this is a massive tailwind.
This isn't just selling bolts.
No, it's selling the thermal management systems that keep missiles and drones from overheating. If that part fails, the whole multi-million-dollar system fails. So again, price is secondary to performance.
Let's break down the segments quickly because there was a clear winner this quarter. The electromechanical group, EMG, just went on a tear.
Tear is the right word. EMG sales were up 15%, organic growth was 14%. What's rare here is the breadth. Every single division in that group grew double digits. Usually you have one laggard, but this was a synchronized surge.
And on the other side, the electronic instruments group, EIG, which has been the weak spot, finally showed signs of life.
It's the turnaround story. The process businesses within EIG finally flipped to positive organic growth low single digits after lagging for several quarters. This is vital because EIG historically has higher margins. If that volume comes back, it drops straight to the bottom line.
Now here's where it gets really interesting and maybe a bit controversial. China. The narrative all year has been China is uninvestable, China is slowing down, but Amatech's China sales were up 10%.
Low double digits, to be precise. That is a massive divergence from the macro narrative. While everyone else is seeing China shrink, Amatech is growing there. It's driven by automation, power, process businesses. It suggests that high-end critical manufacturing in China is still very active.
So the China is dead narrative might be too simplistic.
It's definitely more nuanced than that.
Okay, so let's put this puzzle together. We have record results, a $5 billion war chest, a China surprise. But we still have this light guidance. Is management sandbagging?
That is the big debate. Look, Zapico and Puri are known for being prudent. They guided for a midpoint of 797. The consensus was 801. That is a tiny gap, literally pennies.
Tiny gap.
When you consider they just proved they can price over tariffs, and they have $5 billion to go buy more earnings power, the guidance feels intentionally de-risked.
It feels like they're setting the bar at a height they know they can clear, just so they can keep delivering those beat and raise quarters through 2026. The classic under-promise, over-deliver game.
Exactly. And Zapico made a comment about an industrial renaissance. He noted that after 3 years of negative PMI prints, purchasing managers' index things are finally turning. We are moving from destocking, where customers are just burning through inventory, to normalization.
So the headwinds are turning into tailwinds, but there is a bit of a tricky setup for Q1 specifically, right? I saw a note about margins looking optically lower.
Yes, and this is a trap for unwary investors. They guided for Q1 sales to be up about 10%, which sounds great, but they warned that margins might look lower as a percentage.
Why is that?
It's simply because they own FARO now. And remember, FARO has lower margins until the fix is complete. So in Q1, the mix shift hurts the percentage, even if the absolute dollars are up. Investors need to be ready for that and not panic when they see the margin percentage dip temporarily.
That makes sense. It's short-term pain for long-term gain as they integrate the new asset. Now, we've covered the numbers, the strategy, the mechanics, but we haven't talked about how to actually play this.
Right. And this brings us to the part of the show where we take off the analyst hats and put on the hedge fund idea dinner hats.
Which means it is time for our not financial advice segment.
Standard disclaimer applies. What we are about to discuss is speculative, theoretical, and for entertainment purposes only. Do not trade on this. This is the kind of pitch you'd hear at 2 a.m. in a strategy room.
Okay, lay it on me. We have a company pricing over tariffs, fixing broken businesses, and generating cash. What is the outrageous trade idea here?
I call this the bionic cyclops arbitrage.
The bionic cyclops, that is certainly an image. Explain the thesis.
The core idea is a valuation arbitrage. You go long Amatech and short a basket of pure-play med tech companies.
Okay, walk me through the logic. Why those two?
Because Amatech is quietly mutating. With the Paragon Medical deal and now this LKCI technology deal, hence the Cyclops, plus their European missile defense exposure, they are becoming a defense/medtech hybrid. But the market still prices them like a boring industrial compounder.
So the argument is that they're mislabeled.
Completely. Pure-play medtech stocks often trade at massive multiples, 30, 40 times earnings, because the market loves the stability of healthcare. Amatech trades at a lower industrial multiple. If the market wakes up to this, you could see a multiple re-rating.
So you're betting that the market will eventually realize this isn't just a motor company anymore.
Right, and the catalyst is what I call the FARO acceleration. The street thinks fixing FARO is a slog that will take 3 years. But if that vitality index bleeds into the acquisition and they start launching new products using Amatech's R&D engine, the margins expand much quicker, maybe in 18 months.
So if they fix FARO fast, the earnings beat, and if the market re-rates them as medtech, the multiple expands. It's a double whammy.
Exactly. And the hedge is the beauty of it. If tariffs hit hard, Amatech has just proven they have a positive spread. They price over the tariffs. Pure-play medtech competitors often can't do that because of reimbursement caps from insurance or governments.
They can't just raise prices 5%.
The government says no, Amatech can. So if the macro gets ugly, Amatech eats the competitor's lunch. You're longing pricing power and shorting generic beta.
I love it. The bionic cyclops. It sees the margin expansion coming before anyone else. But again, folks, please do not trade your retirement account on a bionic cyclops.
Please don't. That would be irresponsible.
So let's wrap this up with a final thought for the rational investor. We have a classic Amatech quarter here, record sales, massive cash flow, and a guide that initially spooked the algorithms, but seems designed to let long-term holders sleep well at night.
And keep your eye on that $5 billion war chest. They were very clear that they have an appetite for chunky deals.
Yeah.
The next headline we see might not be an earnings beat. It might be a transformative acquisition that uses up some of that dry powder.
That is the real catalyst to watch. Markets close, but we never stop talking tickers. Thanks for listening to Talk Tickers. Rate, review, and tell a friend. We'll see you next time.